Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to the second webinar this year, specifically for dentists. Today's webinar is titled The OBBBA, What It Means for Your Personal Taxes. So last month, we focused on navigating business tax changes. Obviously, this one is focused on practice owners personally. Coming up on November 20th, we'll be unveiling the results of our 5th annual Dental Salary and Benefit Survey. You can sign up for that at sva.com/dental series. So we have a lot of ground to cover here. So just real quick, you might remember back in 2017, we educated the marketplace on the Tax Cuts and Jobs Act. And then in 2020, we were the leaders in making sure that you all were up to speed on PPP and ERC programs and everything else out there during COVID. And of course, we do these webinars really every fall. So now with the One Big Beautiful Bill Act passing, we're calling it OBBBA to save time, we are out in front again. Obviously, we have this webinar, but keep in mind, we are producing a lot of other content to help you. If you go to sva.com/OBBBA, that's 3 Bs, you'll see additional information like biz tips, recorded webinars, upcoming webinars that we have scheduled. And we do a weekly podcast called The Biz Beat by SVA, where we're spending about 15 to 20 minutes on different aspects of the bill. As far as this webinar goes, please send in any questions you have as we go, but we are going to wait till the end to answer them. If your question doesn't get answered, please reach out to me and I'll make sure one of our subject matter experts gets it answered. So let me introduce our speakers. We've got 2 of our most experienced people from our healthcare and dental practice to walk you through everything today. First off, we have Matt Vanderloo, who's not just a principal here, but is also SVA's CEO. And we have Joel Recklich, who's a principal in our healthcare practice, who works with practice owners and practice managers on efficiency, tax, and profitability strategies. You guys got a lot of ground to cover. Joel, you ready to get going?
Yes. Thank you, Lee, for the introduction. Good afternoon, everyone. Thank you for taking time out of your day to help us listen to the OBBBA updates at the individual tax level. First, we will start with the various TCJA provisions that are made permanent. So starting with the individual income tax rates. So these tax rates were set to revert in 2025 back to where they were at the pre-TCJA level. For example, if you had $600,000 in taxable income in 2017, you would have paid roughly $106,000 in federal taxes. So when the TCJA was implemented in 2018, those taxes went down to $61,000, leading to $45,000 in taxes. So the TCJA reduced the tax bracket percentages across the board, as well as they increased the taxable income within those limitations. So OBBBA, again, is making these rates permanent as well as indexing for inflation going forward. This is tax savings for everyone across the board. Then with the standard deduction, back in 2017, we had the standard deduction and the personal exemption. It was about $13,000 standard deduction, $4,000 personal deduction for the personal exemption. There were some phase outs that started around $320,000. So then the TCJA came in 2018 and said, hey, we're going to increase that standard deduction to $24,000, and then we're going to suspend that personal exemption. So now going forward, this is made permanent. And for 2025, if you're marrying, filing a joint, that standard deduction is $31,500. A few other changes that are made permanent here. We'll start with the child tax credit. Again, before the TCJA, the child tax credit was $1,000. And there was a phase out that started at $110,000 if you were married filing jointly. Many taxpayers could not take advantage of this credit due to that phase out. So then the TCJA came in, doubled that tax credit to $2,000 for qualifying child, as well as increased that phase out to $400,000. So many more taxpayers could take advantage of this credit. Again, these were set to expire in 2025. OBBBA made them permanent, as well as increased that child tax credit to $2,200. Then starting with the TCJA, we have the other dependent credit that was not there beforehand. This is a $500 per dependent credit. And this was, again, set to expire in 25. OBBBA made it permanent, as well as adding some residency requirements. AMT, the TCJA dramatically increased the AMT exemption, as well as the phase out thresholds, to the point where it was very hard to actually get into AMT. Now, again, OBBBA made this permanent. The estate and gift tax exemption was set to revert to $5 million after 2025 and is now extended permanently and will be indexed going forward. Now let's look at the future of some of these provisions. So for the individual tax rate, we have permanent rates providing more certainty for tax management as well as planning. The standard deduction will reduce that taxable income and is helpful for those taxpayers that cannot itemize. The child tax credit, greater tax relief for the taxpayers with families. The other dependent credit, greater tax relief for taxpayers with supporting adult children or elderly relatives. AMT simplifies planning for taxpayers with high income or utilizing accelerated depreciation. The estate and gift tax exemption facilitates wealth transfer planning, optimize tax benefits, and you need to consider revisiting this every few years so you don't get into any future tax exposure. Now let's look at some itemized deductions. So first, we'll start with the state and local taxes. There's a cap, and we'll refer to it as SALT. So prior to the TCJA, there was no limitations on SALT. So your state taxes plus your real estate taxes could go really high. There was some P's limitations we'll talk about on a future slide. But essentially now the TCJA said, hey, we're going to cap this to $10,000. Due to this cap, there's a lot of planning around paying taxes for the practice at the corporate level to get a federal tax deduction. Now with OBBBA coming in, this SALT limitation is increased to $40,000 for those married filing joint, and then 50% that amount for all other filers. There is a phase out. So if your income is between $500 and $600, with every dollar above $500,000, there's a 30-cent reduction. If it gets up to $600,000, it will not drop you below that $10,000 amount. You still need to consider the standard deduction versus itemized deductions, as well as that PTE election to kind of figure out which would be best for you. Here's an example. So in this example, you're married filing joint, you have $500,000 of taxable income. Your Wisconsin tax is going to be about $33,000. Your standard deductions, $31,500. So your Wisconsin taxes plus your real estate taxes will get you to that SALT limit of $40,000. So what other itemized deductions you have? You need to consider charitable contributions as well as your home mortgage interest. And then what is the pass-through entity tax benefit? So the pass-through entity tax allows you to pay your practice profits at the corporate level in Wisconsin. The benefit is the state taxes paid at the corporate level are expensed federally, so it lowers your federal income tax on your individual tax return. If you are currently making the pass-through entity tax election, you need to weigh in those options and possibly consider extending your corporate tax return until you know where you stand federally at the individual level. Now let's look at some other itemized deductions. So with the mortgage interest deduction, so starting in 2018, there is a cap on what you're able to take. So that's loans over $750,000, there's going to be a disallowed portion of the mortgage interest paid. So for example, if you had a mortgage of $1 million, you paid $40,000 in interest, $10,000 would be disallowed as an itemized deduction. OBBBA came in, made this permanent, and they say you can include the mortgage insurance premiums as well. Prior to the TCJA, that home equity debt could be used for up to $100,000, and it could be used on anything. So you could take $100,000 against your home to pay for a car or whatever. That related interest was deductible. The TCJA came in and said, well, you actually need to use this to buy, build, or improve your home, which was set to expire in 2026. Again, OBBBA made this permanent. The casualty loss deduction was set up for major out-of-pocket expenses for unforeseen circumstances like fire, flood, tornadoes. It was a miscellaneous itemized deduction subject to the 2% floor if it was not a federally declared disaster area. So you could get a deduction for the related out-of-pocket expenses. The TCJA came in, they limited this deduction to only the federally declared disaster areas. OBBBA went ahead and made this permanent, as well as included the state declared disasters as well. So miscellaneous itemized deductions have been suspended, and that has been made permanent. There were, back in 2017, you could get, miscellaneous deductions for legal fees, tax prep fees, investment expenses, amongst other items. The P's limitation, again, this is suspended. It was supposed to reinstate. It's permanently removed. This was for the higher income earners here. The TCJA suspended the P's limitation, but OBBBA replaced it with a new cap. So deductions are reduced by 2/37 of the lesser of your itemized deductions or your taxable income exceeding the 37% bracket threshold. Then with charitable contributions for the itemizers, so starting in 2026, itemizers will face a new 0.5 AGI floor on charitable deductions. And let's show an example here. So for those high income donors, those in the top tax bracket, they'll see a slight reduction in the value of their charitable deductions. So if you're in that 37% tax bracket, that tax savings is going to go down to 35%. And then with that new floor, with the gifts of up to 0.5% of your income as well. So in this example, we have $1 million AGI. We have charitable contributions of $100,000. So in the TCJA, you have taxable income of $900,000. You have that 37% tax rate. So you end up with $37,000 in tax savings. Now with OBBBA, you get that 5% reduction. So you only get $95,000 of that $100,000 of charitable contributions. So your taxable income is $905,000. Then that tax savings, instead of being at 37%, it's at 35% for that $95,000, leading to $33,250 in savings. So the result is you're going to end up with $3,750 of less tax savings, as well as $5,000 more in taxable income. Now let's look at the future of these itemized deductions. So with the SALT cap, you got to look at the income management to take advantage of the SALT deductions and really need to avoid those phase outs. We're bringing back that timing of real estate taxes paid. You're going to pay it in December, you're going to pay it in January to see where it pans out the best. This would be best for those itemizers and those that don't have that standard deduction, where it's going to be really close, where you might want to say, hey, every other year I should pay my real estate taxes so I can maybe get above that standard deduction. And the same goes for those estimated tax payments, which are due in January, but you could pay them in December. So again, you could get that deduction. The charitable contribution, there's that 0.5% floor now. It doesn't start until 2026, so you can consider front-loading gifts in 2025. You could even use that donor advised fund so you could spread out those donations over the course of a few years. QCDs continue to be very tax efficient if you're over 70 and a half years old. And with that home equity debt, continue to consider alternative ways to finance items not related to home improvements. Now let's turn it over to Matt to discuss new individual tax items.
Thanks, Joel. Joel did a great job of walking us through some of the existing provisions that we've got some tweaks and changes to. But OBBBA does include some really exciting, interesting, potentially powerful new pieces of legislation on the individual side. So let's dig into a couple of those. The first one, again, relates to charitable contributions, but this is a brand new way to deduct some of those charitable contributions. OBBBA created an above-the-line charitable deduction for up to $1,000 for single tax filers, $2,000 when married filing a joint return. And the powerful thing here is this is an above-the-line deduction. So it's in addition to whatever your standard deduction might be. If you're a married couple filing a joint return and you have $2,000 of charitable contributions, we can take that directly off your income and reduce your income. So in previous years, depending on your level of itemized deductions, you might not have been tracking your charitable because there might not have been a benefit you could realize with these high standard deductions. Going forward, we're going to want to be able to track at least $2,000 of those if you're making $2,000 of charitable contributions, because we have this new above the line deduction. So a brand new exciting provision there that we'll watch out for. This is available starting right away this year in 2025 under 25 returns. We also have an enhanced deduction for seniors starting here in 2025. This is a temporary provision, so not a permanent piece of legislation that's in place, but this is just in place for 2025 through 2028 right now. Remember, seniors, those who are age 65 and older, already get an additional standard deduction on their return. But this is a new $6,000 deduction. It's $6,000 per individual for seniors who are over age 65. This is the promise of not taxing Social Security benefits being realized in OBBBA. So a little bit different than it sounded on the campaign trail, but this is the legislation that came out. That $6,000 deduction per individual, so up to $12,000 for a married couple filing a joint return. There are decent tax savings there on $12,000, but there is a AGI phase out. So if your adjusted gross income is more than $150,000, you're going to lose this deduction as it phases out as your income goes up. So the potential to have some nice tax benefit for some individuals, but might be a little bit limited because of that income phase out. Another piece that's gotten a decent amount of press that's in OBBBA here is the auto loan interest deduction. So this allows for the deduction of interest on an auto loan. It has to be a loan on a new vehicle secured by a lien on that vehicle. In the past, we've never been able to deduct personal auto loan interest on an individual return, but we've got this new provision that would allow up to $10,000 of deduction against income, separate from your itemized deductions, if you meet all the qualifications. The challenge here, I think, for most of our clients, a lot of the clients we work with, is that there's also an income phase out on this. And this deduction phases out at $200,000 of modified adjusted gross income on a married filing joint return. So a limited segment of people who are going to qualify for this. I think one of the applicable areas we might see this happen is with kids. So if you have a kid who's looking to buy a car, this might be a great opportunity for them to get a $10,000 deduction if they can get a loan for the vehicle, also to build up their credit score. It might require a little bit of help from parents to make all the financing work, but if they can check the boxes correctly on this, it's a way to get a $10,000 deduction on a child's return if they're under that, again, that $100,000 or $200,000 AGI limit. So maybe not broad applicability, but in the right circumstances, this is going to be a powerful new deduction for the right taxpayers. I think ultimately, when we look at a lot of the provisions that are changing and that are new, the challenge going forward is going to be, how do we maximize the efficiency of all of these? And how do we get all of our potential itemized deductions and above the line deductions to work together to leverage ourselves into the best tax situation every year? And we're doing all that while keeping in mind that we've got a relatively high standard deduction. In 2025, that standard deduction for a married couple filing a joint return is $31,500. So a relatively big number. But now we've got a new increased deduction for state and local income taxes, that SALT deduction, that can potentially be up to $30,000. So if we have $30,000 of state tax, real estate taxes, income taxes, whatever it might be, we're getting really close to that standard deduction. We just need a little bit more in mortgage interest or a little bit more in charitable contributions to get our itemized deduction to be bigger than the standard deduction. The challenge might be, we just heard on mortgage interest that the home equity line of credit no longer deductible. So if that's how you did your home improvements, that might not be deductible going forward. So that might take some itemized deductions off the table. And on charitable contributions, we have this new AGI floor. So depending on how big your AGI is and what your charitable contributions are, we might be taking all or a lot of those charitable contributions off the table with that floor. And then with that increased SALT deduction, we've got a phase out there. So depending on what your income is, we might revert back to that $10,000 limit on state and local income taxes. So there's a lot of different levers that we can pull here to try and increase your itemized deductions and get you over that standard deduction. But depending on your specific circumstance, we might just not be able to get there, and that standard deduction might still be the best vehicle. We also might have to think of some of our old strategies in new ways. I think traditionally the last few years under TCJA, we've thought about using a donor advised fund to bunch of charitable contributions into 1 year. And usually we've thought about doing it in a high income year, so that if we've got a lot of income, we're going to be in some of those upper brackets. We'll put a bunch of charitable contributions in that year to pull down the effective tax rate. The challenge with that strategy going forward is going to be that AGI floor on charitable contributions. In a year of high income, that AGI floor is going to be really high. So we're going to lose the benefit of a lot of those charitable contributions. So is it still going to make sense to do it a high income year? Or do we maybe have to look for lower income years to maximize the efficiency of those charitable contributions? So lots of different ways to look at these deductions and how we can lump them all together to be most efficient on our tax returns. A few other new items that we're going to see, tax advantage tools and deductions here. One of the big ones that's got a lot in the press that we still need a lot of details on are these Trump accounts. These are accounts that are going to be created for children under the age of 18. Accounts actually can't be open, can't be started until July of 2026. So we still have a lot of details to learn here. And then dollars can be put into those accounts for children. Parents can contribute up to $5,000 a year. Employers will be able to contribute up to $2,500 a year. And those dollars will grow. Child can't access those until they reach age 18. If they do access those dollars at age 18 and before they turn age 59 and a half, there are potential penalties, taxes that are due on those dollars, unless there's a specific exemption, like higher education, purchase of the first home that they're using those dollars for. So potentially a powerful way to put some dollars away for kids in retirement, to be able to use in retirement, and with a long runway of time for those dollars to grow. But still, lots of details we need to learn about how all the specifics are going to work on that account. Couple tweaks to 529 plans. And specifically qualified expenses. The use of these has been expanded just a little bit. A higher annual amount that we can withdraw from 529 plans for kindergarten through 12th grade tuition expenses, that's gone from $10,000 up to $20,000. And then expanded a little bit what we can use those dollars for. The big change here being that they can be used for certain credentialing expenses. The big example we're using here is can be used to maintain your CPA license. So there might be some opportunities there to use 529 plans to maintain dental licenses. If you have dollars sitting out there in a 529 plan that look like they're going to go unused, there's some potential there to maybe think about how you pay for those a little bit differently. So some opportunities there that this OBBBA creates. And then around HSAs, some changes there to expand access and really expand what expenses qualify and the dollars that we can pull out tax-free from an HSA and use without incurring any tax or penalties on those. Here you can see now starting with OBBBA, we can start pulling out direct primary care arrangement expenses, ACA bronze and catastrophic plans. So just a few more ways we can pull dollars out and access those tax-free dollars from HSAs. So that's all OBBBA related. Outside OBBBA, there was one Wisconsin tax law change applicable to individuals that we wanted to get in front of people. It's not going to apply to everyone, but specifically around retirement income. Wisconsin has a new deduction for individuals who are age 67 and older. We can take a deduction of up to $24,000 per person, so up to $48,000 on a married filing joint return, if there's retirement income on the return of more than $24,000. And in this case, retirement income would be pension income, IRA distributions, 401k distributions, any of those dollars that people would typically access in retirement. Not Social Security benefits. Wisconsin already exempts Social Security benefits from tax, so you don't have to worry about using this deduction to exempt your Social Security benefits from Wisconsin tax. But a potentially really powerful deduction here for people who are age 67 or older to exclude some significant amounts of income from their Wisconsin return, just to give you a rough idea at the maximum tax rates, that $24,000 deduction will save individuals about $1,800 in Wisconsin tax. So a really nice potential tax savings there. So a lot of new opportunities, a lot of great things we can take advantage of between OBBBA and then this Wisconsin tax update too, Lee.
Yeah, a lot, no doubt a lot. You guys do such a good job of getting through all that information. I have to admit, you guys live and breathe this all the time. I'm not a CPA. This is it's hard to get your hands around all the changes, all the extensions, the different timelines that these things are going into place, the different phase outs. I guess what I want to ask you, if you had to boil this down, you guys work with dental practice owners all day, every day. What are sort of those main few things out of this that would be their takeaways? What are the main changes? What are the things people really need to be thinking about? If you had to boil down all you just said over the last half an hour into a couple of minutes.
I have two big areas I'd focus on if I were a dental practice owner here, Lee. I think the first piece is we now have a lot of clarity around what tax brackets and tax rates are going to look like well into the future. 12 months ago, we were staring down the barrel of TCJA expiring and tax rates reverting to what they would have been, what they were back in 2017. So 12 months ago, we had a lot of uncertainty about what those rates and brackets would look like. And we're in a much different spot now, which allows people, I think, to start thinking about tax planning and their tax strategy over multiple years with some certainty around what those rates and brackets will look like. So I think for me, that's one big takeaway. The other big takeaway for me is itemized deductions and trying to maximize the tax benefit you're going to get out of those. Because we've got a higher standard deduction and no new rules around the SALT deduction, new rules around what qualifies and doesn't qualify as mortgage interest, new rules around charitable contributions and the floor and the above the line deduction, that there's a lot of different ways to look at those and get those to play together. And a lot of things then that we can also move potentially between an individual return and the return for the practice. And where's the best deduction for that? Where should we have debt? Where shouldn't we have debt? Where should we have charitable contributions? Where should we have advertising costs? And where's the best place to locate all these things?
Yeah, so a lot to think about. You guys, it's great. I think one of the other things that we tend to talk to our clients about a lot is either people who are looking to purchase a practice or people who are looking to sell a practice. Can you talk a little bit about what you think some of the changes in how you might structure those deals with this new legislation, or has that not really changed?
I think, Lee, from my perspective, one of the potentially bigger changes around a practice sale, as a plug for the last webinar we did, anybody who hasn't listened to that business one yet, go back and listen to that, because there was some expansion of the ability to avoid isn't quite the right word, but under the pressure of the moment, avoid is the only word that's coming to my mind. Avoid the capital gains tax related to the sale of a practice if it's a qualified small business. And a lot of the practices we see and work with wouldn't meet most of those qualifications. So if you're getting to the spot where you're looking at selling, I definitely think about that, because there's an opportunity to really just totally not pay tax on a decent portion of the gain if you meet the requirements. So a really powerful tool there. And the expansion of that with OBBBA might make it more accessible to more practices and more taxpayers. Other than that, I don't see a lot in OBBBA that I think is going to change how we look at practice sales and purchases. There hasn't been a dramatic enough shift in the tax laws to think differently about too much of that.
Okay. Well, thanks, guys. You gave our listeners and watchers a lot to think about here. I guess as we wrap up, I just want to let everybody know you can go to sva.com/OBBBA. That's 3 B's to see additional information like biz tips, upcoming webinars that we have scheduled, past webinars that are recorded. And we do a weekly podcast called The Biz Beat by SVA, which I mentioned earlier, where we're spending 15 to 20 minutes on different aspects, typically of this bill or other issues that business owners are going through. So please subscribe on Apple Podcasts, YouTube, or on Spotify. Our next webinar specifically for dentists is on November 20th, where we will be unveiling the results of our fifth annual already, guys, dental salary and benefits survey. And then on December 17th, we'll be discussing investing in vacation rentals. It's called Opportunities and Risks for Dental Professionals. One other reminder, if you're a part of a dental study group that would be interested in hearing more about how this tax bill will affect your membership or its membership, we would be happy to present a customized webinar or in-person presentation. Please reach out to me if you're interested. And if there are other topics you'd find interesting, either for your dental study group or for future webinars, please let us know. That information is great. And just a reminder, this webinar was just designed to be a general overview of how this bill might affect you. But you and your business are unique. Your income, your investments, your long-term plans, and lots of other factors can determine how this is going to affect you. All that to say, now more than ever, you should have a very strong tax and business advisor to help you navigate what's best for you and your business. And guess what? That's where SVA comes in. If you haven't been doing proactive tax planning, now is the time. So we're only a phone call away. If you're a client, reach out to your SVA professional. And if you're not, please reach out to me and we can get you the help or the answers that you need. Thanks for attending today. Have a great rest of your afternoon. And we hope to see you on November 20th, where we unveil the results of our dental salary and benefit survey. Bye.